Hello everyone. This video will walk you through what I'm able to do with the Envestnet Money Guide Pro program. It is actually a program that there's a lot of things I can use it for. I generally use this for folks that come in and want to essentially have a roadmap for what they need to do for what ends up being their most common goal of retirement planning. However, this can also be used for other goals like buying a second home, buying an RV, saving for college, other goals that are out there. It can also be used for things like determining how much life insurance you might need, or disability insurance, or long-term care insurance. It can even go through and look at items like your estate plan and whether you have a need for retitling assets, different trusts, things like that, and even looking at some items like employer stock and restricted stock. Now, I do not tend to use it for that. It can help you determine how much risk you want to take. I use Riskalyze for that. That's something that I like that program a little bit better, and it also integrates directly into Black Diamond. So I like that one a little bit better, and I can use some of those other areas on different programs that I tend to utilize a bit more than this. However, it is a very robust program. It's one that I use a lot, and like I said, this is the most common use that I have for it. So I've put together an example for John and Jane client and give you an idea of what we can do with this. Now, in this case, of course, we're going to go through the table of contents. The first several pages are going to be disclosures, other things like that. They do talk about some projected returns and standard deviations or risk levels that different asset classes take. It also obviously talks about risks associated with investing and whatnot. So gives you a number of different pieces of information at the beginning. But then it starts out and it looks at some personal information. It looks at, in this case, John would like to retire in 2024 when he's 65. Jane would like to retire in the same year when she's 62. And when they're both retired, and also when Jane is alone retired, we'll touch on that in just a second, they want to have income of $78,000 per year. Now, that is in today's dollars. So this is 5 years down the road. That is in today's dollars. We do assume a 3.5% inflation rate, which I'll touch on in just a second. And it's also net of taxes. So this is going to make some estimates on how much tax they'd have to pay. So that is what I call money in your pocket, net types of money. Now, a couple of things about this. I plan out to age 100. We're going to talk about that in a bit, but that's why it shows that Jane alone is retired, because Jane is 3 years younger than John. The other thing that I try to do with this is I try to build in some cushions at a couple of different points. One of them is with base inflation. The Fed has come out recently for the last couple of years and said their inflation goal is 2%. So 3.5 is, fairly aggressive. But what I want to do is I want to build in some cushion with having a higher than normal inflation rate and maybe have a slightly below normal return rate, so that in the end, if one of those is off, we're not caught off guard. Also, you can see that I can put in here that John and Jane currently live in Iowa, and that is going to plug in information for state taxes, but they said they'd like to maybe move to Tennessee when John retires. So the program is able to adjust what the state tax rates are for a different state or whatnot at that retirement. When looking at this chart, this is going to talk a little bit about the life expectancy that I use. It talks about if a person is a smoker or a non-smoker and the probability that they are going to live, or that they're both going to live, or either live to a particular age. And it shows that there's only a 10% probability of them reaching 100 or 101 if they're non-smokers. And I do plan out to age 100. I would rather plan for the what ifs in life. I've often said to folks that while everyone believes that they're never going to live to age 100, I've often said go and talk to someone who is 100 or older and ask them if they thought they would live to that age, and they'll probably tell you no as well. So I would rather plan to age 100. If you pass away before then there's some money left over for your beneficiaries, but I don't want to plan to age 90, for example, and then have you live to age 100. but this gives you some information on life expectancy. Then we're going to jump into the resources, and it's going to talk about John has a 401k with $450,000 in it, and he's putting in $14,300 per year. That ends up being basically a 10% contribution of his income, and the income is going to be shown back on this page. He makes $110,000. Jane makes $42,000 per year. So it's going to be 10% of his gross income pre-tax. We can also put it in after tax if you want, and 3% matched from his employer. Jane, who we're going to say is a teacher, has $175,000 in her 403B, which is similar to a 401k, but more for nonprofit organizations like hospitals and teachers. And she's putting in $5,460 per year. Then they have a joint account that they've put in $225, and it's what the current balance is. They're not contributing to that currently. And they both have Roth IRAs. John has $100,000 in his Roth. Jane has $120,000. And they're putting in the maximum contribution of $7,000 per year. And this program will adjust up if the maximum amount that's allowable from the IRS goes up in future years. We're going to talk about Social Security that John would plan on filing when he retires, essentially at 65 years and 10 months. He'll receive $25,519 at age 66. Jane will file at 62 for a $14,400 annual benefit. Now, these can obviously be adjusted. There's a whole section of strategies available for Social Security and whatnot, but I've made it pretty simple here. Jane, being a teacher, is also going to get IPERS, the public employee retirement system for Iowa teachers and other folks for nonprofits. She'll get a $12,000 benefit that will end at the end of her plan, which in this case is when she turns 100. Tax and inflation assumptions, I assume again a 3.5% inflation rate, but only 1.5% on Social Security, because Social Security does not tend to go up at the full what's called the headline CPI or Consumer Price Index, which is kind of a fancy term for inflation. It's going to factor in federal tax rates and also state tax rates. It's going to look at a lot of different things like long-term capital gains, how much they're taxed on, and it will factor in that 85% of your Social Security benefit is going to be subject to tax, which is something that a lot of programs do not factor in. So something that kind of catches folks off guard. So this is the main page that really talks about whether you can afford to retire based on when you want to and the amount of income that you want to receive. This shows in this first scenario at that $6,500 a month income level, or the $78,000 per year as we talked about before. And it's really saying that there's only about a 66% probability. So that is below what I would consider to be good. I think that you want to have that number up in at least the 80% range. So that's something that we can then go through and talk about a few different scenarios. Now, when you go through and you look at these scenarios with $6,000 a month, $5,500 a month, for example, you can scroll down to this page, and where it's red, you can say, oh, well, I can see there's a reduction from the $78,000 per year benefit that they're looking for. Now they're saying they're willing to take $72,000 or $66,000. But you can also change other variables. In this case, I said, well, what happens if they decide to retire 3 years later? And that's going to show that instead of John retiring at 65 and Jane at 62, John would retire at 68 and Jane at 65. But in that case, they'd be able to get income that's fairly close to their original $6,500 a month. It'd be $6,250. So that says, well, in that instance, you would be able to get roughly the same amount of income, but you'd have about a 13% better probability of your retirement money outliving you. So we can use a lot of different assumptions. I've made this one fairly simplistic because if we have too many moving pieces, it gets hard to keep track of all of it. But you can go through and talk about a lot of different things. And then, of course, this is just showing all of the information before, with John putting 10% into his 401k, Jane putting 13% in. We can also adjust all of this. We can say, how much are they contributing? Maybe they still want to retire at 65 and 62, but they're willing to contribute another $5,000 a year, for example. We can adjust all of that. We can talk about taking different risk levels. We can adjust the performance of the account. This is the Monte Carlo scenario that I talk a bit on my website about, and this is actually showing all these gray squiggly lines are the 1,000 scenarios that they actually go through. And it's going to give you, again, that kind of speedometer, as I call it, to show you overall where you stand. This is for the $6,000 a month option. But it's basically saying if you look at the top 1%, this is a person that retires at the exact perfect time, no real downturns in the market, just perfectly, that they would have at the end of their plan had about $14 million in current dollars left over. Future dollars would be about $63 million. Not super realistic, but it will allow you to go through and look at some of these different scenarios, how long your money will last. As I mentioned on my website, this is something that takes actual historical data based on the allocation that you have and looks at the timing of losses, because obviously a loss in the first few years of retirement can be more detrimental than 20 years down the road. It also talks a little bit about the fluctuations in the market from year to year, as opposed to just having a target of a regular return of 6% or whatnot. I use 6.5%, which again is a bit conservative, but trying to build in some cushion. I tend to look at this 750th trial. In other words, the bottom 25%. The 500th percentile or 50th percentile, is saying that's like flipping a coin. Half the time you're going to be better, half the time you're going to be worse. But I think aiming for this bottom percentile, that's saying, you've got absolutely horrible luck. I don't know if that's super realistic. But even in this 750th trial, it's showing that at year 25, so in this case, this would be when John is 90, that you still have $1.4 million left over. So some folks are okay with that. And this goes through all the different scenarios for the $5,500 a month. And then this is the one that you're delaying by 3 years, but you're getting $6,250. And it shows you how much money is left over. In this case, with the 750th percentile, future dollars, you'd have almost $1 million left over. So it helps you to kind of quantify some of that. Then it will show you, just using average returns, how things would have looked somewhat from a cash flow summary. It'll show you, again, this is showing just a flat 6.5% return. So not as realistic as what I think the Monte Carlo scenarios do, but something that will give you an idea of how much money you're going to need, taxes that you're going to pay out year to year, and some things like that. And of course, it shows any additions that you're going to make between now and retirement. So that goes through for every scenario. Here's the $6,000 month one, and I'm just going to go through these because this is just an example. $5,500 per month, and then $6,250 per month. It also, though, looks at a cash flow chart, and a lot of clients will ask me, well, how exactly is this going to work? When I retire, what's going to happen? Well, in this case, we'll take 2025. Jane will get $12,000 of her IPERs because that doesn't tend to increase with inflation. Jane is going to get her Social Security of $15,746, and John's going to get his Social Security of $27,904. So the total income is $55,649, but your living expenses are $95,000. So you've got a shortfall of $43,000. However, if you scroll down here, your investment earnings are $107,000. So once you take out that $43,000 from this line here, you actually end up in a scenario that your account value goes from $1,691,000 to $1,755,000. So it really shows, how the money is going to come in. That yes, you're going to have an instance that you're not going to have as much income coming in as what your expenses are, but that's where your investments come in to make up the difference. And it helps illustrate that to folks. Now, of course, this goes on for many pages because this is the $6,500 a month scenario. And because we're planning out to age 100, it takes several pages to get to 80 and 85 and finally down to age 100 for folks. So this goes on for quite a while. And then, of course, we start in with the next set of scenarios with $6,000 a month. But it really helps illustrate for folks how much they're going to be able to get, how exactly this is going to work, because it answers the question for folks of how am I going to be able to give up my earning and my salary that I've been getting all along. And that's something that really just scares me to death, and I want to see how this is all going to work out. And then finally, this is one area that I've looked at a little bit. This is a very brief analysis of Social Security. I have a way of analyzing this in more detail, but in order to have this all in one packet, it just shows some information about some different strategy options that are available to folks. And it talks about if someone selects the strategy, in this case of taking money at 65 for John and 62 for Jane, the break-even point, in other words, the year where you're going to break even if you took money earlier versus later, is going to be in their mid to late 60s. And we'll talk about it, other scenarios that are available if you take it at FRA as full retirement age, if you take the money at 70, how much you'd have in total lifetime benefits for, say, this scenario versus this scenario over here, and that type of thing. So it looks at a lot of different things. But again, I have some ways of looking at that in a little bit more detail than what this provides. So again, it goes through that with every scenario, although the numbers in this case are really the same. So that's a brief synopsis of what this program is able to do. It's something I use with clients a lot to have a roadmap so that we're not shaken by the ebbs and flows in the market, and also to help a client determine their overall risk and how it corresponds with their plan. So I hope this has been helpful. If this is something that you're interested in doing, I can send you a questionnaire that I'll have you fill out and will give me the information that I need to run this analysis. And as always, if you have any questions, don't hesitate to call or email me. Thanks very much.